Greetings everyone, welcome to lesson 3. In this lesson, we will start understanding Indian equity market. We will also learn the terms used to denote specific actions. Also, we will talk in detail about important aspects like validity of the trade, margin, settlement, etc. So, let's get started with learning terminologies. The first and the most basic term that we are going to use is CMP or LTP. The CMP means current market price or LTP means last traded price. Now, as the name suggests, this reflects the most recent price of the stock in the live market. As the stock in the live market keeps going up and down, CMP or LTP will also fluctuate up and down. So at any point of the time when we talk about CMP, that means the price at that particular point. The second concept is target, represented by TGT. So whenever we buy shares, we have a specific target price to sell those shares. That is our target. And target is always with reference to stock price. For example, if I am buying a share at 100 rupees, I would want to sell the share at, let us say, 105 rupees. That means if I'm buying at 100 rupees, 105 becomes my target at which I want to sell the stock at. Similarly, there is one more concept called SL or stop loss. Now, stop loss is exactly opposite to target. Targets are set to earn money, whereas stop loss are used to make sure that your loss do not go beyond a certain point. In our example, when we bought share at 100 rupees and our target was 105, let us say our stop loss is 95. That means if the market, instead of going in our favor, goes against us, we want to book our losses at 95, that is book a loss of 5 rupees per share, and do not let the share go below that, or do not face the losses if the share price goes below that. So stop loss is very important in disciplined trading. The mistake that most of the trader does is they do not keep stop loss, they only keep target. That is, suppose they buy the share at 100 rupees and their target is say 105. They keep holding the share even if the stock price falls down to 90, 80 or sometimes even 70. They just keep holding the share with a hope that some or the other day it will go up. Sometimes that day will never come. So a disciplined trader always keeps a target, that is the reward, and the stop loss, that is the risk. Now the difference between stop loss and target is called as your risk reward ratio. If you are buying the share at 100 rupees and 95 is your stop loss and 105 is your target, that means your risk reward ratio is 1:1. That means for 5 rupees risk, you are expecting 5 rupees reward. However, if your target instead of 105 is say 1110 and your stop loss is 295 itself, that means for 5 rupees stop loss, for 5 rupees risk, you're expecting a 10 rupees reward. That means your risk reward ratio is 1:2. So as a beginner, you can start with your risk reward being 1:1, and as a professional trader, you can upgrade slowly to 1:2 or 1:3. As this course will progress ahead, I'll teach you how to manage your risk reward effectively. Just like these terminologies, the other famous terms are BO or bracket order. But before seeing bracket order, let me show you in live how target and stop loss works actually in the live markets. So here I have a random stock whose current market price is around 270, and you will see that I have plotted two horizontal line. One is at 280, the other is at around 260. That means if I am buying at 270, my target should be 280 and my stop loss is say 260. So one of them will be achieved. Either I will make 10 rupees profit or I will make a loss of 10 rupees. Now let us see what happens. Now as the stock is going up or down slowly, you will see that the stock has achieved our target. Now there are a lot of green bars and red bars in this chart. These bars are called as candles. What are candles? We'll talk about that in detail in our upcoming classes. However, for your understanding, you can just understand that if the stock goes up or down, it creates a range of bars. These bars are called as candles. Green bar represents positive candles, red bar represents negative candle. Negative means that the market went up, market went down that day, and green bar represents positive candle. That means that particular day or in that particular time the stock went up. You can see when we bought, a lot of green candles formed and our target of 280 was achieved, as one candle has its tail touching our horizontal line at 280. That means at this point we will book our target. Now once our target is booked, we have to manually cancel our stop loss order. After our target is booked, we will be least bothered about in which direction the stock is going. Whether it is constantly going up or down, it doesn't matter at all, because we have booked our 10 rupees profit in this particular stock. We are out of the trade and now we will find something else. But a lot of people re-enter when they feel that the market is going in their direction. Now this is completely wrong. You see that the stock from 270 has gone to 280. That's it. Now even if the stock goes up, no need to worry, no need to regret about your decision. I'm just showing you here from 270 to 280. After 280 the stock actually went till 300 also. No need to regret that you have missed the rally of 20 more points. We can always find some other trade. Coming back to our terminologies, apart from target and stop loss, the next term that we are going to talk about is bracket order or BO. In BO is a special type of order where when you place a order, you can keep a target and stop loss together. So if target is achieved, stop loss will be automatically cancelled, and if stop loss is achieved, target will be automatically cancelled. Just like bracket order, we have one more type of order called as cover order. In cover order, you can only keep stop loss, your target will be open. So if the market is going in your direction, you can catch the entire rally, and if the market goes against you, a specific stop loss will be triggered. We will talk about bracket order and cover order also in complete detail with live example in our next classes. But for now, just understand that there is current market price at which you buy or sell the stock, and there is target and there is a stop loss. So now let's talk about how actually buying and selling takes place. When you want to buy shares, your orders are matched with corresponding seller who wish to sell at the same price at which you want to buy. Now this is the flow of actual transaction. There is a buyer and there is a seller in the market. Now buyer would place a buy order with his broker, say Zerodha. Broker in turn pushes the order to exchange and an order ID is generated. Similarly, a seller who wants to sell also places a trade with his broker, say his broker is 5 paisa. Broker in turn will push the order to exchange and a order ID will be generated. Now exchange sees if the price of buyer and seller is matching, and if it matches, the exchange will complete the transaction. If the prices are not matching, then the orders will be opened until and unless a new buyer or seller has come to meet your prices. And what does broker and exchange get in return? Why would they allow us to buy or sell shares? Now for every transaction that we do, our broker charges us a fees called brokerage. Now different brokers have different fees or brokerage. For buyer in our example, broker 1 would charge fees and exchange will also charge some tax. So when he wants to buy shares, he is ready to pay the cash, but apart from the cash, he has to pay some brokerage. And apart from brokerage, he has to also pay few taxes like STT, GST, transaction charges to the exchange. And then finally the shares will be transferred and finally the amount will be credited to the seller. Similarly, when seller wants to sell the shares, he also has to pay a brokerage to sell to his broker and also some amount to exchange, and then exchange will deliver the shares to you via your broker. So this is how the entire flow is done. You as a buyer, when you want to buy some shares, apart from the price of the shares, you need to pay brokerage and taxes. And whenever you want to sell the shares, you will receive amount, but taxes and brokerage will be debited from your receiving amount. So when you buy shares, the shares purchased by you can be sold anytime. Since you have bought the shares, you are the owner of those shares, and hence you can do anything with it and keep it till you prefer. However, if you buy and sell the shares within a day, it is called as intraday. So that means clearing your open positions in a day is also called as intraday. Whenever you clear your open position, that process is called as a square off, and when you square off within a day, it is called as intraday. However, if you hold the shares for more than a day, it is called as delivery. Similarly, trades can also be categorized on what type of direction you are expecting the stock to go in. Based upon that, there is category called long position. Long position means buy first, sell later. If you buy a stock and sell it, it is called as long position. The time frame doesn't matter. Even if you sell the shares within a minute, it is still called as long position. As explained earlier, when we buy shares, there is no validity. So long position, that is buying first and selling later, can be done in intraday as well as delivery. If you buy and hold the shares for more than a year, as per government, it is considered as long term. Now remember this, when you buy the share and keep it for more than 1 year, it is called as long term. And if you sell it before 1 year, it is called as short term. So why do we do long position? Why do we buy first and sell later? It is very simple. We buy first because we are expecting the stock to go up, and when the prices of the stock will actually go up, we make money and we sell them later at a higher price. The opposite to this is short position. Short position, as the name suggests, is exactly opposite to long position, that is you sell first and buy later. Now you might be wondering, how can you sell first without even owning the shares? Let me explain it to you. Suppose say you want to sell a pen to your friend. What would you do? You would go to a bookstall, pay him say 10 rupees for the pen, buy the pen and come to your friend and sell it to him say at, let us say, 15 rupees. Now in this transaction, we made 5 rupees profit and is called as long position, because we bought the pen from the bookstall and sold it to our friend later at a higher price. So we were buying first and selling later. However, say you do not have money to buy the pen, what will you do? You will go to bookstall wala bhaiya, ask him pen in the form of credit. You will say, bhaiya please give me a pen, I'll pay you money in evening. That way bhaiya will give you a pen. Now you will take that pen, come to your friend and sell that pen to him first at say 15 rupees. Then take 15 rupees from him, go back to bookstall wala bhaiya and pay him 10 rupees, that is buy back later at 10 rupees. So short position involves a credit, where to sell something you take it credit from someone and then you sell it to someone, make money out of it and buy back later at a lower price. So this is how short position works, and this is exactly how short position works in Indian equity market also. When we feel a particular stock is going to fall down, we will definitely not buy it, but to take the advantage of fall, we can short sell it, that is sell without owning the shares. Now when the prices of the shares will fall down, we can buy later at a lower price, and the difference will be our profit. For example, if I feel that a particular stock at 100 is going to fall down, I am going to sell it at 100 rupees. When the prices will fall down to say 90 rupees, I am going to buy back later at 90 rupees, and the difference, that is 100 minus 90, is our profits. However, to sell the stocks or the shares first, you need to borrow it from exchange, and exchange gives us credit only for 1 day. That is, if you sell first today, you have to square off position today before the close of the market, that is before 3:30 p.m. and return the shares back to the exchange by buying it from someone else. So now stock market is no more gambling, as you can make money even in rising market as well as in falling market. In rising market, just create a long position, and in falling market, just create a short position. So now you should not be worried what if market crashes. We know what to do when market crashes. We will simply short sell. Remember how market crashed during coronavirus fear? If you sell the shares in the morning when the market opens and buy back later during the closing time of the market, you could have made a good amount of wealth. Similarly, the next term associated with the equity is margin. Now what is margin? Margin is nothing but the additional capital provided to you by your broker to help you trade and is valid for both long and short positions. Usually margins are valid for intraday only, as the broker is giving you additional money as credit and wants it back the same day of the settlement, before the settlement. Margin is also called as leverage or exposure. Now once these shares are bought or sold, they have to be credited or debited from buyers or sellers account respectively, and this process is called as settlement. Let us try to understand how settlement is done in India. The shares bought or sold are settled at T plus 2 days. That is, if you buy shares today, it will take 2 days from now to see them in your holdings. And if you sell the shares today, after 2 days, the amount will be credited to your account. Remember, let us say if you are in need of money and if you sell shares worth rupees 1 lakh from your demat account today, you will be able to withdraw that 1 lakh rupees only after T plus 2 days. Now we know that short positions, however, cannot be carried forward for delivery. They are valid only for intraday. But in case you sell the shares and forget to buy the same day, that is, if you keep your short position open, there will be a special settlement in such case. If you short a stock and you don't square off, the shares would go in auction and will be settled on T plus 2 days between 2 p.m. to 2:45 p.m. Until then, you are banned to trade in that stock. So if you, let us say, sell State Bank of India shares on Monday and you forget to buy back on Monday, you are banned to trade in State Bank of India till Wednesday. Now between Monday to Wednesday, State Bank of India can go up and down. However, on Wednesday during settlement, the settlement will be done at the highest price between Monday to Wednesday, that is between T plus 2 days, or 20% above the closing price of previous day of auction. That means if auction is taking place on Wednesday, 20% above the closing price of the market on Tuesday. Say you sell a State Bank of India at 200 on Monday, and on Tuesday the prices are, let us say, at 210, and on Wednesday the settlement will be done at 20% above 210, that is at 252. That means the shares that you sold at 200, now you have to buy at 252 irrespective of whatever price is running in the market right now. Also, apart from this big loss, there is a separate small penalty also that will be imposed on traders for short selling and not squaring off. In short position should be squared off in a day, else there will be a lot of penalty and losses. So this was a brief introduction to equity market. We are going to discuss more of this in coming lessons. So far today we have spoke about what is CMP, what is target, what is stop loss, bracket order, cover order, how buying and selling works, what is long position, what is short position, what is intraday, what is delivery, what is margin, and what is settlement. In our coming classes, we are going to talk about dividend, bonus, taxation in Indian trading system, and a lot more interesting things. So next class will be of so many topics about dividend, bonus, split, LTCG, STCG, other taxes. So I'll see you in the next class. Thank you so much, and spread the knowledge because it's free. You can spread it by liking this video, subscribing and sharing it with your friends. I'll see you in the next video. Thank you so much.